In the ideal scenario, you would do what's called a seamless asset transfer. So what this means is you take the exact assets that you hold in accumulation phase and you in specie transfer them to an account-based pension. So the benefit of this is you don't incur any transaction costs, you don't have any time out of the market, and most importantly, you don't trigger capital gains tax. You don't want to be triggering capital gains tax or unnecessary capital gains tax in accumulation phase of superannuation, because that is your taxable phase of superannuation. Any capital gain that's made that's been held for longer than 12 months is going to get taxed at 10% in accumulation phase. So rather than do that, you take those assets, you transfer those assets into an account-based pension, and if you sell them down in pension phase, well, again, it's a 0% tax entity. So if you think about the power of that, we're probably going to be working what? The average person works 30, 40 years. That is a big amount of capital gains tax that you can accrue in accumulation phase, transfer to an account-based pension, sell down, and pay no capital gains tax. It's important to note here that not all superannuation funds, and in fact a lot of them, don't offer this seamless asset transfer. So if you're in, say, an industry superannuation fund and you're in one of the pre-mixed options, well, that's a pooled arrangement, and so you don't get access to the seamless asset transfer under a pooled arrangement. Some funds do offer what's called a retirement bonus, which is basically like a one-off payment to help compensate for some of the tax benefit. But even still, a lot of funds don't even offer that. So you really want to be careful about what fund you're in. So if you're looking for seamless asset transfers, you generally need to be in something like a wrap platform or a self-managed super fund or one of the more member-directed options.